Consolidated Uranium next. TSXV and OTCQB listed Consolidated Uranium was created in early 2020 to capitalize on an anticipated uranium market resurgence using the proven model of diversified project consolidation. Philip will explain in a moment what that is. And so far, Consolidated has stakes in 13 different projects in 4 different countries, USA, Canada, Australia, and Argentina. The portfolio is diversified across geography, style of development, and deposit type, and all the assets are in top uranium and mining jurisdictions. We're delighted to be joined by Philip Williams, Chairman and CEO at Consolidated Uranium.
Thank you, Donald. You took the words right out of my mouth. That's a very good introduction. We are a global uranium developer. I'll take you through exactly where our projects are. And a very new company. We've only been around for 2 years, but we've been very aggressive building our portfolio. But our real focus is on our near-term production assets in the US. These are past-producing mines. And you can see from the picture on the front page, we have a tremendous, this is our Tony M project in Utah. It's got a tremendous amount of infrastructure because it was in past production, and it could be moved ahead rapidly as market conditions continue to improve. And we'll talk about that as we go. Forward-looking statements. So when we started this company two years ago, it was really based on the following 3 tenets. It was the right strategy. So uranium had been in a 10-year bear market post-Fukushima, and we saw that was coming to an end. 2 years later, uranium prices have doubled, and we think that there's continuing strong tailwinds in the sector. And this consolidation strategy that Donald pointed out, this strategy was proven in the past bull market, and I'll explain to you why and give you an example of that and the kind of trajectory that we think we can take on that basis. And so we've been focused for the last 2 years on building the portfolio through M&A. We're now switching our model to advancing the projects in our portfolio through work programs. And you'll see in a second that we've got drill programs underway at our main projects in the US, and we're going to start doing work on our other projects very shortly. We're also built it around the right team. So the company was originally founded by the founders of Next Gen Energy and Mega Uranium, names that you may or may not be familiar with, but these are bellwethers in the space. And over the last 2 years, we've added to our board and management team significantly, particularly in the area of technical expertise. And I'll show you that in a second. And then the right assets. And this diversified approach was taken for a reason. Uranium is an extremely difficult commodity to develop, historically speaking. And so we wanted to put assets in the portfolio in different geographies at different stages of development and different deposit types. In case we had any issues with one particular geography or deposit, we had other projects to fall back on. And as Donald pointed out, we're in top uranium and mining jurisdictions around the world, again, focused on the US. And we're also fully funded to execute on our business plan in front of us. And I'll show you that right now in the cap table. So you can see, we have had a very strong performance in the share price over the last 2 years, commensurate with the uranium market coming back, of course. We have over $28 million in working capital. We've raised $50 million in the last 2 years, primarily from institutional investors, some of whom are listed on the page here. There's many other institutions behind this that we don't list. I will highlight that Energy Fuels is our largest shareholder at almost 18%. Energy Fuels is one of the top US-based uranium mining companies, and they got this position through the transaction that we did with them, where we acquired the projects in the US. And Dave Talbot, who many of you are familiar with, covers the company. This is the team. Myself, I've been in uranium since 2006. I was a sell-side research analyst for many years. I joined the buy side and worked at an investment fund based in Toronto that we managed over $1 billion in assets with a significant focus on uranium. I then went into investment banking for several years, banked a lot of the uranium companies in the industry. And then in 2017, with some partners, I started the first and only uranium royalty company, which is now public. And I came over to Consolidated 2 years ago. As part of my background, I spent a lot of time in the field looking at uranium projects. I've been to over 100 projects around the world, including many that we've purchased as part of the portfolio. I won't spend any time on much time on the rest of the team, other than to point out this transition from M&A to actual project level work made it so that we needed to bring technical expertise to the team, Late last year, we added Marty Tunney. He's a professional mining engineer. He's permitted and built mines in the Americas. And Mark Chalmers, the CEO of Energy Fuels, recently joined the board as part of the transaction with them. Mark's a 40-year mining engineer. He's built and operated uranium mines all over the world and has been a tremendous addition to the team. Talk about consolidation being a proven strategy. I think this slide's instructive to the kind of opportunity there is for investors in the uranium space. And it's really a tale of two kind of business plans. So when we first started the company 2 years ago, we put together the chart on the top of this slide here. And this tracks Mega Uranium, which was one of the consolidators in that first big bull market in the uranium space, which was in 05, 06, and then early 07 when uranium prices made all-time highs. And you can see in this chart, so uranium prices had gone from went from $20 to $66 over this period. Mega completed 9 acquisitions, raised significant capital. The share price increased 3,400%, and the market cap of the company went from 15 million to 940. So again, this was our business plan. Now, 2 years later, the chart on the bottom shows our performance. And over a similar 2-year period, we've seen uranium prices go from 27. They peaked at around 64.25. They pulled back now into the high 40s. We've completed 80 acquisitions. We've raised a significant amount of capital, had a great increase in our share price, up 1,800%, and our market cap went from $2 million when we started the company. It peaked at 200. It's pulled back to about 150 million now. But I think what this is instructive of is to show that there's a significant amount of runway in uranium equity valuations. If you're a believer that the uranium price is going to go back to those highs that we saw in 2007, it went up to about $137 per pound. And that value increase potential is for our company and other names in the space, of course. Okay, so here we'll dig into the portfolio. This is the map of the world. We're in Canada, we're in Australia, we're in the US, we're in Argentina. Again, these are mining jurisdictions, these are nuclear jurisdictions, and these are jurisdictions with uranium mines. We've got a significant resource base across all of these projects at over 100 million pounds of uranium. We also have a significant vanadium resource, and vanadium and uranium are found together quite often around the world. 2 of our current projects have uranium and vanadium together. One project, which is in the blue there, Moran Lake, which is in Labrador, we recently spun that out into a new entity, Labrador Uranium. It's up and listed. It's raised nearly $20 million, and it's about to undertake an aggressive exploration program this year. And that's just instructive as to one of the ways that we can realize value from this significant portfolio. Our focus, as I pointed out from the beginning, is on the US projects, which are the ones in the dark green label with the white lettering. These are located in Utah and Colorado, and that's going to be the focus of the presentation. So let's get right into that. Here is a zoom in of the projects that we acquired. As I said, they're in Utah and Colorado. The primary projects that we're focused on are the Rim Mine, the Tony M Mine, and the Daneros Mine in southeastern Utah. It should be pointed out that Utah is an extremely mining-friendly jurisdiction. It ranks second only behind Nevada in the US in terms of states, in terms of favorability towards mining. And the points that I'd like you to take away from this slide as we walk through it are these are historic mines in prolific uranium districts. Many millions of pounds of uranium have been mined in this area over the years. And as being past producing mines, a significant amount of CapEx has already been spent on these projects. These projects were built and in operation in that past bull market. Over $100 million was spent on these. And what that means is that's money that we do not have to spend in order to move these back into production. Our CapEx, we're anticipating to be very, very low in the single-digit millions of dollars to bring these mines back into production. There are historic uranium resources in all of these projects with exploration upside. We're drilling these projects right now, both to confirm those resources and expand upon them. And I'll take you through that in a second. What's also critical about these projects is all the state and federal operating permits are in place to bring these back into production in a very near term. And what that does is it saves us time, particularly 3 to 5 years is the estimate. If you wanted to permit a new conventional mine in the US today, that's the length of time you're looking at to get those permits. We don't have to get those permits. Those permits are all in good standing right now. So what we're doing right now is we're completing those drill programs and getting ready to make a production decision on these mines towards the second half of the year. And why we can make a production decision over that time period, it's not just that they were built, not just that we have the operating permits, but that we have access to the Energy Fuels White Mesa mill. And one of the vagaries of conventional uranium mining, of course, is that you need a mill to process the ore. There's only one operable licensed mill in the US today, and that's the Energy Fuels mill. All of our projects are in trucking distance. And importantly, we have a toll milling agreement with Energy Fuels to process our ore at the mill. We'll talk about that a little bit more here, because the transaction that we entered into with Energy Fuels to acquire these assets was more than just an asset purchase. It was a proper strategic alliance, which had kind of three agreements behind it. The toll milling agreement, which I just touched on, which is a tremendous asset for our company, in that we are the only company that has a toll milling agreement with Energy Fuels for access to the mill, meaning we're the only one that has guaranteed access to the mill other than Energy Fuels itself. So our peers who have conventional assets, and they might be past producers with all the capex spent, they might have their operating permits in place, but if they don't have access to the mill, they don't have anywhere they can actually process that or turn it into yellow cake, the product that you'll ultimately end up selling. That strategic alliance also includes an investor rights agreement, which governs the Energy Fuels' rights as a large shareholder in the company. It includes equity participation, so they can maintain their pro rata position in our company and future equity financings and that board seat. The third part of the alliance is this operating agreement, which I show there on the bottom left-hand side of the page. And what this means is that we get access to the full Energy Fuels team to move these projects ahead. And here's what that looks like, and why it's important to us. First of all, as a small company and understanding that we wanted to move projects ahead, we'd need to build up our own team, and we're starting to do that. Under Marty, we have 2 geologists and a permitting person on our team, but we also get access to, under the operating agreement, the full Energy Fuels team within all the different disciplines that you need to actually turn on and operate mines. But importantly, we don't have to employ these people full time. We get to second them to our projects as needed, and of course we pay for it. But I think it's a big distinguishing factor between us and some of our junior peers who don't have access to such a substantial team. Particularly these Energy Fuels people, they've worked on these projects before. They were on these projects when they were in past production, so they know exactly what to do in order to bring them back into production. So now we'll talk about the projects individually. Tony M, which is the largest resource of the projects. Again, this was a historic mine. Over 1 million pounds of production has been taken out of this mine up until 2008. As I said, it's got a significant resource at almost 11 million pounds of uranium at a very strong grade. This project has tremendous infrastructure. So we talk about 18 miles of underground development. In the 80s, when this development was put in, it cost $60 million. That's part of that 100 million I talked about before, and that's dollars that we don't have to spend. We can effectively go right into these workings and get right to the ore face and mine almost immediately. There's also significant surface infrastructure. I showed you in the picture at the beginning, and more in the picture here. $15 million was spent by Denison in the 2000s putting in this infrastructure. It's all in good shape, and we can immediately use that when we start production at this mine. The project was well drilled. There's over 6,500 holes, 1.5 million feet of drilling. We're very, very confident in the resource here. What we've just completed is an 8-hole program inside that blue circle in the plan map there to basically confirm the historic resource and bring it up to a 43-101 current resource, which we should have out in the next couple of months. Following that, we'll undertake a PEA on this project. The second project, Daneros, again, was in production in the past cycle. This mine closed down in 2013. 1 million pounds of historic production came out of this mine, and we believe there's a lot more to come out. Notwithstanding that the resource we quote here is quite small in terms of the absolute number of pounds, at just under 200,000 pounds, we see tremendous exploration potential here. And we're going to send a rig in a couple of weeks down to this project to test that exploration potential. And just to highlight what that looks like, if you look at the plan map and you sort of see pink blobs and orange blobs within the pink, the orange is the historic resource that's quoted there. The pink is where we have historic results that are ore grade or widths that aren't captured in that resource. So our plan is to go in where this blue circle is here and drill some of the in those pink areas or offset those pink areas to test for exploration potential. Beyond this area here, trending to the northeast about a mile, we've seen, again, historic results that are ore grade and ore widths that we can follow up over time. So the potential is tremendous for this project. The third project is the Rim Mine, again, a past producing mine. This mine shut down in 2009. Similar story to Dineros in that it's a relatively small resource, but tremendous exploration potential. One thing I would highlight about this resource, and we talked about vanadium when I took you through the map, this project has a very high-grade vanadium byproduct. At 1.8% vanadium, that would rank it as one of the highest-grade vanadium projects in the world in its own right, not to mention the uranium grade, which would effectively double, but the vanadium effectively doubles the uranium grade. We're drilling here right now in that blue circle. Again, it's similar story, pink blobs, orange blobs is the historic resource. We have historic results that aren't calculated in that resource, where we have ore grades, ore widths that we're drilling within the blue box circle to extend that mineralization, and we'll have results from here very shortly. I mentioned we're fully permitted. Just to hammer that point home, here's the list of all the permits we have. You can see everything's checked that is required. The important permits are the plan of operations from the BLM and the mine permit from Utah State. Those are the permits that I mentioned would take 3 to 5 years to get, particularly now where a new mine would require an EIS. These permits were kept in good standing. I mean that we can turn these mines on very, very quickly as market conditions continue to improve. I'll spend a second talking about the US and why it's a very important jurisdiction and why we're extremely excited to have projects in the US. The US is the largest consumer of uranium because it has the largest fleet of nuclear power plants. Yet it has a very small domestic uranium production. And over the last few years, and particularly of late with everything that's happening geopolitically around the world, and security of domestic supplies become a hot button issue for the US. And a number of different initiatives have been launched to try to spur domestic production. Our projects would qualify for a lot of these programs as they come to pass. And what it means in terms of valuation is that US-based US producers tend to trade at a premium valuation, particularly if they have near-term production potential. So what we have here is a very simple valuation table which shows enterprise value per pound of resource. And you can see, and I'll go through it in a bit more detail for those who might not be familiar with the individual names, but these three names on the left-hand side of the page, Ur-Energy, Energy Fuels, and UEC, these are the bellwethers of the US industry. These are companies that have licensed production, we're in past production, and generally regarded as the companies that will be back in production soonest. And so you can see they trade at a significant premium to the developer peers that are listed here on the right-hand side of the page in the green. And what we would argue is that not only don't we belong at the very bottom end of the range relative vis-a-vis the US developer peers, we're ultimately moving towards production. We have near-term production assets, so ultimately we should re-rate into the category with those three companies on the left-hand side of the page. And that's a function of us finishing these work programs and communicating to the market that our strategy is really to move these projects ahead into production. Not going to spend much time talking about the rest of the portfolio. We have projects, as you saw, in different countries at different stages of development, and we're going to start doing some work on these projects, particularly Argentina and Australia this year. And so there'll be news about those projects in the next few months. And really that's what we say here in our catalyst slide. What you're going to see from the company are results from the US projects and more direction about our timetable to move those ahead. You're going to see results from our Argentina project, and we're going to initiate work on our Australian projects. And I would also highlight that we're very busy evaluating new opportunities. M&A has picked up significantly in the uranium space. We've been very active in the last 2 years. We've done 8 different transactions. We'll continue to be active going forward. And I think the landscape is going to change significantly over the next year or two. And I think we'll be a big part of those changes. In summary, it's an attractive portfolio of uranium projects. We're in top tier jurisdictions. We have high grade on a global scale with significant past expenditures at our projects and near-term production potential in the US. We're very busy evaluating new opportunities. And I think that if you use history as a guide, you'll see that we're going to be very busy going forward. We have a compelling valuation and we're well funded to execute on our business plan. And we think outperform in the coming bull market. And we have a proven track record, again, not just based on what we've done over the last 2 years, but what the individuals on our team bring to the company.
Okay, Philip, thank you very much indeed. Let's start the Q&A. Let's start at the very start of uranium, shall we? Uranium and vanadium, what exactly are they used for commercially and industrially?
Okay, yes, great question. Uranium has one use. It's to power nuclear power plants. So all the reactors around the world, 440 odd reactors, all require uranium every year as fuel for those reactors.
Okay, Britain's soon to have some mini reactors. In the Ukraine, they've got nuclear reactors, but they're in the middle of a war zone. So to what extent do these ebbs and flows in terms of demand, where do they leave sentiment at the moment vis-a-vis uranium?
Sure. I mean, look, uranium demand is quite slow moving. And it doesn't, other than black swan events like Fukushima, where reactors in Japan and then ultimately Germany came offline, you don't see a lot of sort of demand changes that you can't predict. So a new reactor takes 10 years to permit and build, and you know when they're coming on. So you can really understand, again, outside of black swan events, how much uranium is acquired on a year-to-year basis. But I would say that generally speaking, uranium and nuclear power is becoming much more desirable, globally, particularly as we look to reduce the carbon emissions from power generation. And increasingly, nuclear is being branded as low carbon, particularly the quality as a baseload source of power. And I think it's being more and more understood that it's required part of the mix to keep a low carbon electricity generation footprint.
France is keen on it. Germany has abandoned it. Why do you think this super cycle is going to happen? What does it say in your bones? What do your bones tell you about what you just think of as the super cycle to come?
Yeah, look, I think that that there are some outlier countries who are saying no to nuclear power, but I think they're increasingly getting pushed in that direction. The small modular reactor projects that you're talking about, they're getting a lot of traction and they have a lot of favorable qualities. But I think ultimately it's places like China that are growing their fleets and they're not going to stop because pollution is a real thing and they need baseload sources of power, and renewables can't fill the gap as quickly as everybody would like. So nuclear has a role to play, and in fact, it's new reactor builds, it's extending lives of reactors that we're seeing in the news every day, notwithstanding a few negative headlines here and there out of countries like Germany and alike.
Okay, so what was your strategy in terms of you've got 13 different projects at the moment? I understand. We'll come to Utah in a moment, but why such a broad portfolio of assets, and what exactly do you plan to do with them? Are you going to trade them on when the price gets stronger? Are you going to do the inferred and material resource thing and build them up? What's the plan?
So the original strategy was we needed a diversified portfolio because the geopolitical risk around developing a uranium project can be quite high. And what we've seen in the last 15 plus years is that jurisdiction can go from pro-uranium development to anti-uranium development almost overnight, and you can't see it coming. And historically, single asset, single jurisdiction companies in the uranium space are inherently higher risk. So we wanted to put together a portfolio that insulated us from that risk. And now as we've advanced the portfolio, and we started off doing smaller acquisitions, and we've ultimately done bigger acquisitions, a la the Energy Fuels transaction, what we're going to do is continue to build out our production portfolio and development portfolio. So it's produce in the US and find a development project to come behind that. It could be something in our existing portfolio, or it might be something that we bring in. And as we build that portfolio up, in terms of the proper development assets. Some of the assets in the portfolio may not fit. And now what we did with Labrador, we might look to spin those off. And the key thing about Labrador Uranium is the shares that Consolidated took, we gave them directly to our shareholders. So all shareholders got direct exposure to that in a stub of a share for each share they own in CUR. And we'll continue to do that as our strategy if we go ahead and spin out other projects.
Okay, Josh Cole asks that very question. He says, have you considered farming out the smaller assets? Which is exactly what you're talking about, yes. So then to focus your cash flow in Utah, which is the biggie.
That's right. So the answer is yes. But I think, and again, Labrador, I think, demonstrates how we made 1 + 1 = something more than 2. So we took our project and we took projects that a company called Altius had that were around our project. We combined them into Labrador Uranium and made a very, very large ground position in an extremely exciting camp and a more focused exploration play out of Labrador Uranium than just developing the resources that we had ourselves in Labrador.
Did you feel that the whole Labrador experience was a positive thing for the company? Did you make money out of it?
Oh, it was a tremendously positive experience between what we paid for the asset, what we ultimately put it into Labrador for, and then the ability to bring on additional capital. Again, we raised $18 million in it, and now it's going to spend $7 or $8 million this summer drilling and exploring in that camp.
So a positive experience. Okay. Another question from Pete Higgins this time. Given the current global geo and macro issues, we're hearing about more talk about clean energy. Clearly, it's all about clean energy. So where do you feel that uranium sits in this ESG clean energy space?
Well, I feel like it sits right in the middle. There's different sides to that argument, but it's low carbon baseload power generation. And so it belongs in the mix with wind and solar and some of the other renewable sources. It has a role to play. And increasingly, I think that the world is understanding that role. Definitely different ends of the political spectrum might have a different view on it. But ultimately, I don't think we can get to these net zero goals that people are talking about without including nuclear.
Okay. We're coming to the end of our time, which is a great shame because it's absolutely fascinating. The bear market in uranium, what drove that, and what's to say it's not going to, the good times are not going to come back?
I mean, look, it was driven by Fukushima. So we had a black swan event. We had a reactor go down, and ultimately Japan turned off all the reactors, and then other countries followed suit. We can't sort of necessarily plan for another black swan event, but what it has led to is it's led to 10 years or more of underinvestment in exploration and development in uranium. And the reactors still need the fuel, and mines have turned off and exploration has stopped. So the rubber will hit the road at some point where the price will have to rise dramatically in order to bring on new production and new exploration, even just to meet the needs of the existing reactors. Unless the entire reactor fleet goes down, that demand is required year in, year out. And those are long life assets that can't shut down. They need to stay on to keep power into their grids.
Philip, when might that moment be? When might the rubber hit the road, in your most elegant phrase?
Look, we've seen it sort of hit the road this year already. Uranium prices are up. They were much higher than they are today. They pulled back on a spot price basis, but I think we've got 12 to 18 months before things, particularly on the long-term contracting side of the equation, come to the fore and prices rise dramatically. Okay.
Thank you so much, Philip. You've been a complete star. My goodness, you talk very quickly and pack a lot in there. That was fantastic. Thank you.
Okay, great. Thanks very much.
No, it's very educational for us. We don't really get that. You're the first in 4 years. You're the first uranium explorer developer that we've actually spoken to on LSE. So thank you so much. It's been huge. Thank you very much.